Hello and welcome to the Advanced Trading course. My name is Christy, also known as Christykins in the Discord or in YouTube world. I have been working with Artie for a couple of years now, teaching educational content and helping you guys learn how to trade as well. This part of the course is going to build upon the things that you have learned with Artie. It is advanced in the way that
how to sign up, how to deposit, how to make an internal transfer, how to download the MT4 platform, password. It will now send a verification known as a KYC, which stands for Know Your Client. They need this information
that is advanced for a newer trader. If you are an experienced trader, most of this will be repeat information, but it's always nice to have a refresher course. Determining market sentiment. Market sentiment is the overall opinion and push of the market for where majority of traders feel the market is going. Every trader develops their own individual opinion of how the market will go. What direction do they believe it's going to go, whether it will go up or whether it will go down? This is your market sentiment. The entire market is composed of every single trader's market sentiment. When it is all totaled up and averaged together, creating a greater push in one direction or another because perhaps more people feel that they want to buy. They feel the price is low, it's a good price, they want to get in, they want to buy there. That in turn will push the market in a bullish direction, and that will cause market sentiment to be pushing up in an upwards trend. That overall force of all of those traders agreeing and then everyone else hopping on and also helping to push it will help form momentum in the market to push the market the direction that the overall market sentiment of these traders is heading. So even though you may have individual market sentiment, your own feelings of where you feel the market is going, there's also the overall market sentiment approach that you could trade, and that would be basically trading with the overall trend. That's what it ultimately comes down to, is like, which way is the market trending? Where are a majority of people trying to get in at and push the market to? That is for you to figure out how to determine this. So how do you approach trading that? You could use something like indicators or technical analysis to help build your market sentiment strategy. Things like a trend line, something very simple and very easy to draw, you could use. That would fall under a technical analysis approach. Or you could use something like an indicator that already detects trend for you, or a volume indicator, or a momentum indicator. Something like that will tell you where majority of the people are and which way they are pushing the actual market. There are multiple types of indicators out there. I already touched a little bit on some of the indicators. We will not go into detail in this basic course about those, but you will learn more about them throughout the Discord and throughout videos. You will also have an entire course available to you to learn how to do technical analysis, so I'm not going to show you guys the exact way to enter into these market sentiment trades, because all of that will be covered in further courses. I just want you to understand that there is ways to trade it. And when someone says that they trade with a market sentiment approach, what they're meaning basically is that they are trading with the overall trend where a majority of people are also entering and trading, and they are pushing that market in that direction. A saying that you will hear very frequently is the trend is your friend, and we highly suggest that you trade with the overall trend if you are a beginner trader. It is the safest way to trade, and you will do better trading that way than trying to fight the force of market sentiment where they are trying to push against you. So you do not want to get into a sell when you have a very bullish market. That would be foolish to do. You are literally setting yourself up for failure. However, there's also the saying that the trend is your friend until it bends. And that is 100% true as well. So this is something you will have to learn how to determine whether you should be entering or waiting perhaps for a reversal or a retracement to happen. The market can only go in one direction for so long without it having to pause and retrace or reverse a little bit to end up equaling the price out a little bit more. It can't go in one direction forever. So this will be up to you guys to decide whether market sentiment is going to continue in one direction or whether more people will see it hit a certain area and decide, maybe it's time to go the opposite way. There will always be movement back and forth where it will push up and it may come back down again and then push up further. And that is how your market structure will be formed. I will show you guys an example. So this is an example here that you're seeing of a bullish sentiment. Just a very basic overall, you can see that most people are buying and they are looking to push this market up. So you would not look to try to sell in a market like this because you're just looking for losses. You are more likely going to lose if you're trying to enter in all of these selling positions. To trade with the overall trend is the better idea here. This is a bearish market sentiment. You can see how strong this trend is as well. Most people are looking to take a short position here. You can see in both pictures when I show you the bullish market and the bearish market, it does not go straight up or straight down. What is forming is what we refer to as market structure in both of these pictures. You have situations where it shoots up, but then you get a push back. And then it shoots up again and a pushback, then shoots up even higher and then a pushback. Artie went over this a little bit in his course where he talks about lows and higher lows and lower lows, and I'm sure that your head probably was spinning a bit if you are new to trading. There are plenty of charts that you guys can look at that we can also provide you with in the Discord to help that sink in a little bit. But just try to remember that nothing can go up or down forever, no matter how strong the market sentiment is or the trend is. Has to be some sort of equaling out of that price. So that is why you will see pushes up and then a little bit of an answer for it. And then another push up and some answering for it. And a nice strong then push up and some answering for it. It happens here again, even in the selling market. You get a drop, a little bit of a pushback, a drop, a little bit of a pushback. So you are getting what we call market structure forming, where you step-like pattern, where you drop down, you make a little step, drop down, make a step, drop down, make a step. Another thing that a lot of people find themselves doing when they are beginners is trading things that don't actually correlate, but trying to trade them together. I'll get into this a little bit more in this slide. So basically, there's always some sort of correlation between all of the different types of currency pairs that you can trade in Forex. Some of them go in the same direction, some are the opposite, and some are just like random as far as how they relate to one another. It is imperative that you guys understand how each of these pairs correlate to one another, especially if you're going to be trading multiple pairs at the same time. Some of them will move together in the same direction and others will move against one another. You don't want to potentially take two trades with pairs that are totally opposite, but trying to take them both the same direction. So hypothetically, say you wanted to buy two different pairs and you wanted to buy on both of them, but they're opposites when it comes to their currency correlation. You would want to make sure that you are checking your chart for this, because that would be dumb to do. You would end up losing one of those trades. One of them will win and one of them will lose. Because of its currency correlation, it will inevitably go the opposite direction of the other pair. So this will allow you guys to have better risk management when it comes to choosing which currency pairs you want to trade and how you're going to go about trading them. For example, GBP JPY, that is the Great British Pound versus the Japanese Yen, has a strong positive correlation when it comes to the CAD JPY. CAD is the Canadian dollar versus the Japanese yen. That has a 91.4% correlation rate. This means that they will move in the same direction. When one rises, the other will rise too. So in the example I previously gave where I said if you wouldn't want to take a buy for both pairs if they were opposites, in this case, you could take two buys, GBP JPY being one of them, CAD JPY being the other one. If you took both positions as a buy, both of those pairs, and the market went up, you would win both of them because both of them would be trending in an upwards direction due to their 91.4% correlation. On the opposite end are the pairs that are total polar opposites and move against each other. So for example, USD CAD, which would be the US dollar versus the Canadian dollar, has a strong negative correlation. When it comes to the CAD JPY, that's the Canadian dollar versus the Japanese yen. Those two pairs correlation is a negative 83.4%. This means that they will move in opposite directions of one another. One will rise and then the other one would fall. You would not want to trade both of those pairs in the same exact direction. This would mean that one of them would potentially win and one of them would lose. You would never win both of them if you were trading them in the same direction. If you guys are interested in learning more about this, I will show you a currency correlation chart that is available at myfxbooks.com. It is completely free and you guys can go on there and you can use it. You could even print out potentially a little card for yourself to keep on your desk or stick on your computer while you're still getting used to currency correlations and just have an idea of something to glance at. So this is the myforexbooks.com that you guys can come to. I'll just show you what it looks like on the actual website. And they have all of the pairs listed here. So this currency is where you would look to find the one that you're interested in. And then you would just look over to the right to see how does it line up with whatever you're interested in correlating it with. I'm going to show you guys an actual chart in a minute and just show you guys what it would look like so you can visualize it. So AUD-CAD you can see here is your very first one. So that is what we are looking at as far as our primary currency. So let's say we want to look at what is related to AUD-CAD because we want to trade that. So what else can we trade that day? We can see that AUD-JPY has an 82% rate where it correlates. So that's a great correlation rate and you could trade both of those together in the same direction. But then come here and look, you can see you have Euro-AUD, which is negative 92.9%. They are polar opposites and you would not trade both of these together in the same direction. I'm going to show you guys now on an actual chart markup what that would look like. So just remember we're looking for AUD-CAD and then we'll be looking at Euro AUD so that way you have an understanding of how they go in different directions. So here is the AUD-CAD chart that I'm showing you guys. You can see it is clearly in a bullish trend. It is pushing upwards. So this is an upward trend and you would say you want to get into a buy on your AUD-CAD pair and you want to know, can you buy something else? The other pair we said was the Euro-AUD, that you would not want to trade those together. So on our next slide, you'll see with Euro-AUD, that's up here at the top, you can see during the same dates and time frames that it's strong bearish trend that is happening. It is going in the opposite direction where our first pair, the AUD-CAD, was going. So you would not want to buy for both of these. You would lose this trade if you took anything in this market. You would only win potentially this one. So that is to explain to you guys how you want to be aware of that. Instead of trading something like Euro AUD, if you wanted to trade AUD-CAD, you would find something that correlates well with AUD-CAD. So like I showed you here on AUD-JPY, you would look to trade something like AUD-JPY and AUD-CAD together. So that way they would stay together. So I just want you guys to be aware that there are strong correlations between some of these pairs. So when you're looking to take buys and sells on multiple pairs, just double check your currency charts and make sure that they make sense to be trading them together or in separate directions. What is a commodities market? Commodities are something that a lot of people like to trade. You can trade things like gold, oil, and grains. These are a part of what we call commodities market, and it is the selling of like materials or raw materials. The types of commodities that you have, there are two. There's hard commodities and soft commodities. Hard commodities are things that are extracted from the earth. So your metals, or your oils. So you have gold, silver. I believe there's platinum on most of the platforms now, crude oil, things of that nature. Soft commodities would be agricultural or seasonal products like meats, grains, and lumber. We don't really see that too often when it comes to the Forex market, but in other stocks and things like that, you may see those. In order to trade in the commodities market, a good or a commodity has to be interchangeable or fungible. So no matter where extracted or grown, it has to be the same. So if I'm mining oil in the US, it would need to be the same type of thing that was being mined in some other part of the world. Or if I was having gold mines here in the US, it would have to be the same thing that was being gold somewhere else in the world. So it all has to be the same, and it has to be a tangible, fungible thing. So where can you trade commodities at? There are 3 worldwide markets. There's CME Group, Intercontinental Exchange, and then the London Metal Exchange. Those are the 3 largest ones when it comes to trading commodities outside of the Forex market. Then there is also the Forex market itself that will allow you to trade commodities. This is broker selective, so you will need to check with your personal brokers to make sure that they will allow the trade of certain commodities. Not all commodities are allowed to be traded within the Forex market. Typically, you'll see the bigger ones like oil, gold, silver, and platinum. Beyond that, you don't always see the other ones, but it is potential that your specific broker may allow more. If you want to trade all of these types of commodities, then you would need to potentially look more towards those 3 larger worldwide markets to trade them. When it comes to trading them, there are hard and the soft commodities that I already previously explained. Hard ones, the easiest way to think of them is think of them as being extracted. These are commodities that need to be taken out of the earth in order to be made, not grown. So extracted is hard commodities. Energy sources such as crude oil, gasoline, heating oil, and natural gas, those would qualify as it. Also things like metals like gold, silver, copper, platinum, things that you would have to dig up out of the earth. The soft commodities are ones you can grow, so on top of the earth. So there will be things like seasonal items, grains, meats, and then also lumber and dairy products. When it comes to the brokers, I already touched on this a bit, but every broker is different and has different rules. So make sure that you're checking with your specific broker to see if they allow you to trade commodities. So how do we actually trade commodities? There are 2 options. There's spot and future markets that you can trade through the exchanges. Spot market would fall into ETFs or stocks. This would be purchasing or investing. Some people do like to buy them and hold on to these, and then other people like to just day trade them. You would either purchase and hold, or you would purchase and day trade them. You would be getting the commodities directly, and it would be an immediate delivery of the commodities price to you at that point in time. If you were doing it in the futures market, what you would be doing is buying a set number or a set amount of contracts at a set price, at the current price that it is, and you would be securing that price for future data or future price. So to give you guys an example, because I know this can be difficult to wrap your head around when you're first learning this, let's say, for example, that it is February of 2022, and we want to buy a contract of crude oil through the CME exchange at the price of 91.50. At the time we are buying it, the contract will expire now in March of 2022. We are buying in February of 2022, and then the contract will expire in March of 2022. So in 1 month, it will expire. We are buying it at the price of 91.50. If the price shoots up in the course of that next month, and during March of 2022, oil goes through the roof and you bought at a lower price of 91.50, and say hypothetically the price shoots up to 200, you will make the difference between 91.50 and 200, and that would be your profit you would make at the time that that contract expires. So that is why it's called futures. You're trading the future price of what it would be, but you're securing it at that current price at the time you're purchasing it. It can be quite confusing, and for those of you who are looking to trade futures, this is definitely more of like a background type of knowledge, but you should understand it. But I promise once you start actually trading it, it's not quite as complicated, because you kind of get used to the idea and it starts to make more sense when you're doing it in a live market. For those of you who do better with like real life examples, at the time that I'm actually making this video, it is March of 2022. So if we use my current example, I was just saying, say we hypothetically bought oil in February of 2022, you had secured it at a price of 91.50, and your contract is due to expire in March of 2022. In current events right now in the real life, Ukraine is at war, and that has happened over the course of February into March. So that has affected in real life the price of oil. So had you bought oil in February prior to them being attacked and held that contract and had it expiring in March of 2022, now oil is very overpriced and it has gone up. So you would have made money in the difference that the price had jumped from that 91.50 you purchased at to whatever it may have jumped up to. So that is how you would trade it. And you would also be able to use current events or news events to help you decide whether you should or shouldn't be buying into certain things when it comes to commodities, things that are needed and how valuable they are at that time or how valuable they may become due to certain circumstances. When it comes to purchasing the EFTs, the ones you can get immediate delivery of, like where you would execute a trade and it would go through right away and you would be trading the current price in the current market, you would purchase EFTs through a broker. You can purchase them through futures markets, Forex market. There are many other platforms now too that allow the trade of commodities. So you would have to look into it, like I said previously. And the only thing that you should be aware of is that make sure you understand what their contract size is. What that basically means is what the broker is looking to have that sell for. So every 1 point movement on the chart, what would that equal to you as far as a profit gain or loss? You'll see that more specifically on how to find your contract sizes when you watch the how to use MT4 video. That will be reviewed how you can look through all the data and find the information about each specific pair that you're looking to trade. So this is just a screenshot here for you guys to see. This is from Hugo's Way. That is the broker that I use. Just showing you all of the different things you can trade with this broker. You can see you have the basic Forex pairs, the major ones. There are exotic currency pairs as well that sometimes people like to trade. Indices, my personal favorite, which I will get into in the next slide, explaining them further. Futures, which I just touched on for you guys. Stocks, which most people, even if you have no background at all, at least have heard of the stock market and understand like the concept of them. So those are available on here. Forex crosses, energy, metals, that's your gold, silver, platinums that we were talking about. And then you have your crypto. Crypto I am not going to be covering in this course here. That will have an entirely different video for it because it is a beast all on its own, but it is acceptable to trade on here as well. So you can see on my particular broker, like you can pretty much cover a majority of things that anybody would want to trade, which is really nice. Whatever your specific broker is, you should check and just verify whatever it is that you are interested in trading, that they do allow you to trade it. If not, you can always look for another broker. There are thousands of brokers. So don't worry if you can't find what you're looking for on one broker, another broker definitely has it. So what is a stock market index? Indexes are referred to as indices. US indices are probably the most common that you will see and kind of the big boys when it comes to indices, but there are other indices beyond US. You will see things like the German 30 or 40. You will see things like Hong Kong 100. You'll see the Australian 100, the France 100. So most countries have their own version of this, but when it comes to the most popular ones and the ones that move the most and get a lot of volume and attention, the US indices tend to be the big hitters. But there are three major ones that you'll see the most. There is the S&P 500. That is the top 500 companies that are combined together to make that up. Then there is the NASDAQ, that is referred to as NAS 100, that is US top 100 companies. And then lastly, the Dow Jones, which is also called US 30, and that makes up the top 30 companies in the US. An index is a managed tradable product that tracks the performance of a group of stocks. Indices are managed through a weight-based model, and they can either have like market caps, equal, or price weighted. So Essentially, what that means is that you are taking the top 500 companies, and there are different weights to each company. So think of it almost like a ranking, is the easiest way I can think to explain it. That there will be the number one company, and there's like the 500 number company in there. So the number one company may hold more weight when it comes to how the actual market will move versus like the 500 companies. So if that number one company has an awful day, some horrible news drops about them, that means that the US 500 will probably drop. You will see a significant drop in it because that number one company is weighted more than the other ones. Even if the other ones are having an okay day and they aren't affected by the news, having that company that holds more weight, has more stock in it, will pull that company's shares down. That is the easiest way I can explain it. But once again, I just want to stress, I'm just explaining the background of this for you. So don't get so caught up in feeling like you have to know every single little detail. Just understand that it is the top 500 companies, 130 companies that you are trading. And you are trading a stock. You are not trading an actual currency like you are in the Forex pairs. You are trading portions of a stock, and each company that makes them up holds different weight. So since you are trading the companies and not necessarily the currencies, you're trading portions of the stock of these companies, it is important to understand that current events can affect this as well as news events. Just like with commodities, where something big, like I explained, the attacks on Ukraine, could affect something like oil and the price of it, the same thing can happen with these companies. If some massive news release happens about, let's say, Apple has a news event that happens that's pretty extreme, you will see that reflected in the way that these US indices will move. They will move because of that. So it is important to have some sense of news events and current events that are going on if you want to trade things like indices. So I just dabbled on talking about trading news, so let's get into a little bit more detail about what is trading news and what does that mean? What is a news day? Important events affecting a country's economy or a geopolitical event like war or a natural disaster will affect it. Every country has news events that regularly affects their currency or the markets like commodities or indices. And the interest rates, decisions, inflation, or employment data can all be huge things that affect how these pairs will move. There's also major US news events that happen every single month and are big game changers. So make sure you are aware of these. Even if you don't live in the US, even if you don't trade USD pairs, you still should be aware of these because they can correlate, which we already talked about in a previous slide. You can have a correlation movement. So if you have a pair that you're trading, even though it may not have a USD in it, it may very well correlate strongly with USD and therefore will move because of these news events. You will have something called NFP. This is non-farm payroll. This happens every Friday of the first of the month. No matter what, it's always happening. That is huge news that is released. It is always red, high impact news. You want to be aware of that. If you are a new trader, I highly suggest you do not even trade that day. That is your day off. Take it off, go do something fun. Do not trade it. You will regret it. We all have been burned by NFP before. So take that day off or sit back and just watch it. So that way you can kind of see what it does, because there is some massive news spikes that you will see, and they are very hard to predict and very hard to control. I do not recommend trading that for newer traders. Other high impact news events that you will come across, you can see here, are the unemployment claims, the CPI, the FOMC. Those are all things that you are going to see also, and anytime you see them come up, you should not trade them, or you should at least wait until that news has been released. And then after it has calmed down, you can then get back into the markets. So I know you're like, Christy, why would I even trade news? You just made it sound horrible. I'm terrified. I never want to trade anything anytime news is dropping. There is a potential to make a large amount of money pretty quickly, and the market has increased volatility. So that can be beneficial to you, but also as fast as that trade may move in your favor and make you money, it can also move against you and lose you money. So until you are ready to handle that type of pressure, I highly recommend you just avoid it for a little while. You also risk having things like large slippage, increased spreads, and unfulfilled market orders. This has actually happened to me before, where there was so much volatility, the market had moved so fast that my broker wasn't even able to keep up with it and didn't trigger my stop loss, meaning that my order continued to go in drawdown and went extremely negative. And that is a very hard thing to deal with when you are a newer trader. Psychologically, it really can mess you up. So I learned my lesson a long time ago when I was a beginner as well, to just not mess with NFP until I was ready. And I really urge you guys to please be aware of it. So now you know not to trade high impact news, but you need to know where to find it. So I know you're like, okay, well, I know I shouldn't trade high impact news, but like when I start looking at this news calendar, there's news events all day long, every day. When do I trade that? And can you trade? Like, should you still trade news? And the answer is yes. You can still trade regular news events. All trading involves risk management regardless. And news happens all the time, every day. It's whether you are going to be trading with high impact news or whether you will trade with medium or only low impact news. And on high impact heavy news release days, you want to be very cautious or potentially sit those days out because you are having increased risk with the volatility in the market. On days where it's just medium impact to low impact, those are just normal days, like just getting the news like you would on any other day. So you don't need to worry about those. Although it can be potentially profitable for you to still trade the volatility, high impact news days are always more dangerous because of the increased slippage and volatility and the larger spreads that a lot of brokers will put out during that time release. So please be aware of that. Do not trade high impact news ever. Just wait until you are more comfortable. If you are an intermediate to experienced trader, obviously trade at your own risk when it comes to trading high impact news events. So you're like, okay, Christy, how do I trade the news now? Like, I know you said I shouldn't, but how would I do it if I wanted to? In one ear and out the other, I know. Anyhow, so if you wanted to trade the news, if you are an intermediate to an advanced trader and you want to trade the news, you have a couple of options. You have one option, which is just to develop a strategy specifically for news trading, which means you would go about strategy testing and back testing only during high impact news time. The other option you could look at potentially doing is using larger stop losses. Make sure you're safe from any potential news spikes, using a lower risk percentage. You could also trade the major Forex currency pairs that are a little bit safer and kind of slower. So like Euro USD, kind of a little bit slower at times, AUD USD, and you could use smaller position sizes to decrease your risk as well. So combining things like larger stop losses, smaller risk percentage that you risk, and a smaller position size will all help to decrease your risk if you still choose to trade through high impact news. So I know you're like, okay, that's great. I need to know about high impact, medium, low impact, but like, how do I figure that out? Where can you find news that's affecting the market? For Forex markets, you can go to forexfactory.com or you can go to myfxbooks.com and go to their economic calendar. There's also a link here for just indices if you're interested in just looking up those specific companies and seeing if there's any high impact news for the companies that fall into those indices. As just a quick reminder, just don't forget that NFP, that is huge. That is the first Friday of every month. So always consider high impact news there and just be very cautious on this day if you choose to trade. So here is just a quick screenshot of what MyFX Books looks like when you look at their economic calendar. And you can just see here on the screen, it will give you the date and the time of the news release. It will also give you the flag and the country that is releasing the news, and it will give you the impact, low, medium, high. And you can see that it will go through all the different dates. You can look at yesterday, today, tomorrow, this week, next week. There's a calendar to customize which dates you are looking at. So make sure that you do use these. These are all free. So definitely look at them. It's a good habit to get into before you get in the charts, to just pop this open and peek at your day and see like what news will be dropping during the sessions when you're trading, and see if any of those currencies that you're looking to trade would be affected by that news. Position sizing is something that I find so many people mess up or do not follow correctly, and it is huge. It is very important when it comes to proper risk management, separating you from gambling essentially versus actually trading. So you do not want to be gambling and just guessing what lot size or what position size to be taking, because then you have no idea how much you're actually risking. So it's important to understand position sizing. So there's a few things you need to know in order to be able to decide what your position size should be. You're going to need to know these 5 things over on the left here, 1 through 5. You need an account size. You need to know your currency pair you are trading. You need to know the percentage of the account you would like to risk. You need to know a stop loss size. That is something that will be determined by the markup that you do on the actual charts. And then you need to know the currency pair exchange rates. If you look at the right side of the chart here, what you'll see is all the mathematics done. Do not overwhelm yourselves looking at this and going, oh crap, I'm so bad at math. How am I ever going to be able to trade? I'm just giving up. You don't need to give up. You can be lazy and use a calculator. The math is here for you guys to understand the basics of how it is calculated, but you do not need to actually know how to do this in your head. No one is expecting you to sit there and be counting it all out super fast while you are looking to take a trade, but it is written out so you understand how the math is done behind the scenes. For those of you who are lazy like me, you can just use a calculator. And there are multiple options for you to choose from. There are 3 of them here on the bottom. There is the position size calculator by MyFXBooks. There's also a position size calculator that is built into our trading floor journal sheet that you guys will see for backtesting and journaling. Jay has a video where he explains how to use that and how to also use the journaling and backtesting sheet. So I definitely encourage you guys to use that if you are interested in it. Because that allows you to have one thing up on your screen and you can still journal your trades, you can keep track of your win rates and all of that, as well as having access to your calculator right there, all on one sheet. And then lastly, you guys are also getting the trading floor built-in MT4 risk calculator that is available to all members for you guys to use. And that one is a little bit more sophisticated because it's an actual EA that is installed, and there is a video explaining how to download the EA and how to install it to your MT4 platform. So you guys can follow that as well. But if you're just practicing and still trying to get used to the whole idea of calculating it all, feel free to just go with the MyForexBooks calculator or the trading floor calculator that is built in, just to kind of get a feel for it. And then once you're ready to start demoing and live trading, you can use the MT4 built-in. Here is an example of a position size calculator. This is an additional one that you could also look at that a lot of members have been using and liking. So this is the cashback4x.com calculator. This is also free and you can find it online. This one has all of the instruments you could want to trade as far as Forex pairs. There, I believe crypto is in here, gold is in here, and the indices are all in here. In some cases, not every calculator includes all of them, so this is a popular one because you don't have to have multiple calculators then. This will calculate whatever it is that you are trading. I'm going to show you guys an example of how you would enter this into the calculator and use the lazy way like I would be doing it, but using the example that I showed you guys on the slide that broke it down, showing it manually. So in that example, we said we will be trading AUD USD, so I have that selected. You want to select the currency that you are depositing or withdrawing from for your particular broker. For me, that is USD, so that's what's selected, but there are all different types of currencies that you can choose from, so pick whatever one it is that you are working in. Then you have stop loss in pips. For us in our example, it was 20, so I put 20 here. Account balance was 100K, so that is 100K. And then risk percentage is 1%. I do want to show you a couple of things that can be changed here. So if you are somebody who likes to trade with the opening price and the closing price and use that to calculate, you can switch this. So if you hover over the wheel on the stop loss area, you can click on switch to stop loss price. So if you don't know how to figure out how many pips it is or points it is and that's confusing you, you can always figure out what the price is. So you can just enter in those instead, and you could put in the opening price and the closing price and the stop loss price, and it will automatically figure out for you how many points or pips it is that the market is moving. I personally like to just enter in the pips, but you could do whatever you feel. So let's fix that back to 20, like our example said. And then this is also something you can change the percentage. So we want to risk 1%, but you can change it to risking a set amount. So for me, I'm trading with USD. So let's say hypothetically, the most I wanted to lose was 500 USD dollars. So I could just say I only want to lose the maximum of $500, and it would then calculate for me what the proper lot size is that I need in order to only risk $500 with a 20 pip stop loss. So that's what I would enter in when I go to enter my trade. I would enter 2.5 lot sizes. In the example I showed you though, we wanted to risk 1% of our overall balance. So let's calculate that. So to risk 1% of our 100K balance with a 20 pip stop loss, it would equal out to a 5 lot size. So that's what you would enter in when you are entering in your trade on MT4 or 5 or C Trader platform. You would enter in 5 lots. So that's how you would look at just entering it in. You can keep this up on the side or like split your screens if you have dual monitors, whatever works best for you guys, but always make sure that you're using these calculators to make sure that you are actually practicing good risk management. It is very important that you are not over risking or just winging it or just guesstimating what you want your stop loss to be or your position size or your lot size. It can be extremely dangerous to your capital that you're trading. And at that point, it almost becomes gambling. That is a bad habit, and you really want to get into good habits as early on as possible. So I'll take you back to the slide with this example, and you can see that when we did the manual math, it was 5 lots. And if you are lazy, like I said I am, the calculator will also do it for you and tell you 5 lots. So here we are back again. You guys can see the 5 lots after we do all of the math here. For all of the criteria that we put into the calculator, it will equal out to being 5 lots for you to be risking. You don't need to do all of this math. Just use the calculators. There are more than enough of them that we are providing here for you. So please find one you like, find one that's easy for you to use, and make sure you're using it for every trade that you enter. Setting stop losses is very important. You need to be trading with stop losses, and yes, you should be using a stop loss for every trade. You cannot just guesstimate where you want to close the trade out and say, oh, I'm just going to manually close it when it gets to a certain number. That's a very bad habit to have, and it takes an immense amount of willpower for you to close a losing trade out. We are programmed to not believe in losing. So when it comes to having to accept a loss, it is very hard for many new traders and even experienced traders to hit the close button, because you're always thinking, you're like, just 5 more, just 10 more. It's going to go back. It's going to go back. It's going to go back, because you can't handle the reality that it's losing. We just are wired to not lose, from a very young age. So when it comes to having to psychologically deal with the fact that you're about to close out a losing trade, it's extremely hard. So to avoid putting yourself in a position where you know that you may not be able to close a trade out, just use the stop losses. The computer doesn't care, and it will close it out for you when it hits a certain area. So make sure that you're using stop losses every time. Get in the habit of placing them with every single trade, no matter what. You have to use good risk management. The key to being successful is to protect your capital. And by keeping your losses small and having your winners be bigger, you will be able to do this. You are allowed to lose. You are not expected to win 100% of the time. Losses are inevitable and they will happen. And the sooner that you learn how to accept the losses and just take them for what they are, they're just losses, they are part of the process, and it's not a big deal because you're keeping good risk management plan in place, then you will be fine. Risk management, which I will show you on the next slide, will keep your account profitable. So the losses don't matter as long as you are being smart about them. Now that you know you need to use a stop loss with every single trade, figuring out where you should be setting them is something that is important. And there are two ways that you can go about setting a stop loss. One of them is to use location-based stop losses. This would be using something like market structure, where you would potentially look for a swing high or a swing low or support and resistance areas. You will learn more about that in the technical analysis video that Brutus will be giving you guys, but that would be one way where you would be looking for areas to place a stop loss, and it would be individual to each trade. The second way that you can look at placing stop loss is having a fixed amount, meaning that every single trade, no matter what the market looks like, you are constantly only going to risk 20 pips or 30 pips or 40 pips. You have a fixed amount that you will only allow yourself to potentially lose. A lot of people like this when they have rule-based systems and they have a fixed stop loss in a fixed take profit ratio. So for instance, you may have something where you will only risk 20 pips, but you will have a take profit of 40 pips all the time. So you will potentially risk 1% to make 2%. A tip that any experienced trader will share with newer traders is do not move your stop losses. Don't close your trades early and don't move the stop losses. This is a habit that you do not want to get into early on, and it is also something that you will inevitably probably do as a new trader, as we have all done it. You will panic the moment you place trades. You will see drawdown, you will see negative numbers on your account, and you will get panicky and you will exit your trade out right away because, oh my gosh, you'll be frantic. And next thing you know, the trade goes in the direction you thought it was, and you could have, should have, would have made so much money, and then you get the FOMO effect. You have the fear of missing out. You start making all kinds of crazy trades, and it's just a spiral effect. So please do not move stop losses. Do not close trades early. You have evaluated your trades, you have made an educated analysis on the trade, and you're accepting that risk when you place it. So don't close it out too soon. Allow it to play out properly. If you're using the right position size, you're using a stop loss, and it is good risk management plan in place, you will be fine. So don't go tinkering with things and messing that up. I promise it will hurt you more times than it will ever benefit you. There is one exception to when you can consider moving your stop loss, and that is once your trade is in profit and it is well into profit. You want to now secure your trade, or you want to make it what we call risk-free, meaning you take your stop loss and you now move it to slightly in profit to be able to let the trade run, but also know that if it comes back and hits that now newly placed stop loss, you will not lose money now because the market has moved enough for you to safely move your stop loss to just a little bit into the profit zone.